Good afternoon and welcome to our webinar on Do You Know What Your Company is Really Worth? I'm Andrew Coates, one of the Directors of Strategic Corporate Finance. What we're going to cover this afternoon is just a brief introduction about who we are, who Strategic Corporate Finance is, to explain our experience and why we can talk about valuation. We're going to talk about the importance of valuations, different valuation methodologies, a bit about strategic premium, and at the end, a bit about how we can help and answer any questions. So please do, while we're talking, if you've got any questions, please use the Q&A facility that's at the top of your screen or at the bottom of your screen, depending on how you're viewing this webinar, to ask questions, and we'll answer all of them if we can, or most of them, at the end of this session. We have had one or two questions in advance by email, but please do use the Q&A facility to ask questions, and we'll pick up on those at the end of the webinar. So I'm going to start by just introducing Strategic Corporate Finance and who we are and what we do. We are a team of professional advisors. We're all chartered accountants by qualification, who many years ago started specialising full-time in acting for clients looking to buy or sell their business. We give quite a lot of early stage advice. We believe in giving our clients the benefit of our experience so they understand what their options are, they understand what the likely value is going to be, whether a trade sale route is the best route or a management buyout is the best route, and if we're acting for a management team, what a management buyout is likely to look like in terms of valuation, what can be funded, the amount of equity going into the deal. So we do a lot of early stage advice, really to give clients the information they need to take an informed decision on whether they should be doing an acquisition or disposal, whether the timing is right and how the transaction is likely to look and end up. So as part of acting for clients on buying and selling businesses, we receive offers on many businesses we're selling. We make offers on behalf of clients, and getting the valuation right and understanding the valuation is an important part of that service. And we've got over 20 years experience of valuations, well over 20 years experience of valuations and buying and selling businesses, that gives us the in-depth knowledge of how businesses ought to be valued and are valued. We provide lead deal advisory services as our main service, seeing a client, steering a client through a transaction, whether that is an acquisition or disposal, from the start to the finish, from the early stage advice to then acting on the transaction. And if it's a trade sale, doing worldwide research using subscription databases that we pay for to find buyers for the business. If it's a corporate client looking to make acquisitions, we'll use our subscription databases plus other sources to identify target companies that meet their criteria. We've got a lot of experience with trade sales, and we've got a lot of experience with management buyouts. We find that roughly half our transactions have been trade sales or trade acquisitions, and about half have been management buyouts, often acting for the vendors and often acting for the management team. So we see our job is guiding a client through a transaction. Many clients only go through a transaction once in their life, and guiding them through it, allowing them, if they're a vendor, to get the value that they've built up over many years and find a safe pair of hands to take the business forwards. Three of us on the slide. As I say, we're all chartered accountants. We've all been working together as a team for many years and really enjoy what we're doing. And it's really satisfying to help clients achieve their aspirations. This slide shows some of the deals we've completed. Many different sectors, many different deals, many different types. The same thumbnail photos appear on our website, the Strategic Corporate Finance website, and are clickable. So if you're interested in any of the deals, if any stand out, you want to know more about that deal, click on the photo on our website in the deals history section, and it'll tell you a bit about those transactions. So at this stage, I'm going to hand over to Greg, who's going to take us through the rest of the content. I'll come back at the end just to talk about how we can help and to answer some of the questions. Thanks, Greg.
Thanks very much for that introduction, Andrew. Afternoon, everyone. Thanks for listening. So first of all, why is valuation important to business owners? Well, the first thing to say, of course, is that for most business owners, their company is the most valuable asset and will be a key component of their retirement plans. So it's extremely important to understand exactly what that asset is worth and what factors drive that valuation, and what can be done to increase the valuation, and conversely, what things that might be detracting from the business's value. So for any business owners who are thinking about selling in the near future, having knowledge about valuation is really important. But also business owners at any stage, if they're just starting up a business, or even if they're not looking to sell for 10 years or more, having that knowledge of how businesses are valued it is critical to help them make good decisions that are going to help build capital value over the long term. And by the same token, having that knowledge about valuation can help business owners avoid some really sort of costly mistakes. And I've noted on this slide some fairly sort of common examples that we come across in the course of our work. Most notably, perhaps, is business owners looking to sell their company and perhaps having inflated price expectations and going into a sale process and then not receiving offers anywhere near that meet their expectations. So that can be a hugely frustrating and also expensive mistake that business owners make. Also failing to recognise good offers that may come out of the blue. Maybe trade buyers may express an interest in buying a company, put forward an offer, and that isn't taken up if business owners feel that they have unrealistic expectations. Share options is another example where having a good understanding of business valuation is important. We often come across situations where share option schemes are set up where the share option price is set too high and are ineffective, or even too low, and then are sort of overly generous when it comes to rewarding employees in a business. And finally, situations where minority shareholders need to be bought out by a company. There is a trap here that business owners need to be aware of. If they overvalue the business at this stage and then pay too much money to buy out minority shareholders, that can destroy equity value and really sort of make it really difficult to achieve their own retirement plans. So moving on to why valuations are difficult and can be difficult. First of all, there's a lack of comparable data out there for owners of small and medium-sized businesses. If you're dealing in public companies and dealing with listed shares, it's very easy. There's comparable data online in terms of what companies are worth. For private businesses, that data doesn't exist. Where companies are bought and sold, the terms are more often than not kept confidential, and so it's difficult to kind of benchmark one company with another. Where deal values are disclosed when businesses change hands, you often don't have the full picture because the accounts that may be filed at Companies House might be missing a profit and loss account, or even if a P&L account is published, the reported profitability shown in those accounts bears no relation to what the underlying level of profitability is for various reasons. So it's very difficult to kind of find that comparable data from looking at other transactions, and this is why involving professional advisors who have knowledge of deals is really important. The third point on that slide, valuations involve more than just looking at numbers and working out a calculation. It requires an in-depth understanding of the business that's being valued. Each business is unique and has its own sort of factors that would affect the valuation. Most notably, it's sort of a growth profile, any sort of major risks in the business, and those sort of intangible factors, they don't show up on a set of accounts, and you really need to understand about a business in order to come up with a meaningful valuation. And finally, there is a degree of judgment that's needed to weigh up all the different factors that go into a valuation. And again, so it's not as easy as just working out a calculation, turning the handle, and coming out with a valuation. It is more complicated than that. It is more of an art rather than a science. So for those sorts of reasons, it's important to be skeptical about free valuations or very simplistic valuations that you might get from a web page, for example. Free valuations, they're not going to involve the in-depth sort of analysis of a business that's required to come up with a meaningful valuation. And of course, there's no such thing as a free lunch. If somebody is offering something for free, it's likely they're maybe bias involved, and that they want something out of it. Moving on to how the different kinds of methodologies that you see when it comes to valuing businesses. From our perspective, most of the time we follow a multiple of profits methodology in working out the valuation of clients' businesses, and I'll talk more about that in the following slides. But there are other methods that are often used. So the first of those is a simple multiple of revenues, or specifically recurring revenues. And you might see this in certain sort of sectors, such as insurance brokers or firms of accountants, where there's a rule of thumb, and valuations are roughly based on recurring revenues. But at the same time, it's important not to completely ignore the multiple of profits valuation methodology, even if you are using a multiple of revenues method, because at the end of the day, it's the profitability of a business that is most important, and it's that really should be used to drive valuation. The other alternative you might see is a valuation based on balance sheet value or net asset value, and this might be appropriate for businesses that are loss-making. Maybe they're not a going concern, and so you can't really work out a valuation based on a multiple of profits, and it might be more appropriate to look at the breakup value of the business using its balance sheet as a way of deriving its market value. And the third other sort of alternative that is sometimes used is what's called discounted cash flow. And this might be used for perhaps early stage businesses where there isn't a track record of profitability, but you can sort of work out a valuation based on forecast profits and cash flows over a number of years, and then apply a discount factor to reflect the level of risk in the business and the time value of money, and to work backwards to arrive at, say, a valuation of shares at the current point in time. So that's methodology tends to be seen more, like I say, for early stage businesses, and perhaps also for tax purposes for share options. So just talking a bit more about the main method that we use in our work, which is the multiple of profits method. This involves a very sort of simplistic formula at the outset, which is the underlying profit of a business multiplied by a figure which we term the earnings multiple. I'll talk about those in more detail in a second. The multiple of profits methodology is used for mature businesses that have a track record of profitability, rather than sort of loss-making or early stage businesses. And this method gives us what's called the cash and debt-free value or enterprise value. And that is the valuation of the business as a whole, including the value that's attributable to the shareholders plus amounts that may be owed to debt providers. So some further adjustments are required to take to get you from the debt and cash free value to the equity value, which is the important figure when it comes to the owners of a company. So what is the underlying profit that should be used to put into that calculation? Because there's different profit figures on a P&L account. The profit figure that we use most often is operating profits or earnings before interest and tax, EBIT. But the reason we use this rather than EBITDA, which excludes depreciation and amortization, is that it's important to factor into the valuation the ongoing needs of the business to reinvest in fixed assets. Sometimes EBITDA, it is okay to use as the basis for valuation if it's a service-based business where there isn't a very significant capital investment requirements. On the other hand, if it's a very capital-intensive business, if it's a manufacturing business with a continual need to reinvest in plant and machinery or a haulage business, then it's critical to use EBIT rather than EBITDA when it comes to working out valuation. Several adjustments are needed to the EBIT number before working out the valuation. So if there's any exceptional amounts of income or exceptional costs, those need to be drawn out and adjusted for. Usually there's a need to adjust for a true cost of management in small businesses. Usually the owners of the business are involved in actually managing the company. They may only take a nominal level of salary, instead taking dividends in lieu of sort of market rate salaries. So an adjustment to profit would be required to ensure that the underlying level of profitability reflects the true cost of management. It may be that the company owns its own premises and therefore doesn't pay any rent, and again an adjustment might be required to include a notional level of rent because the property that's owned by the company will be treated as a surplus asset, which I'll talk about in a moment. And also it's important to think about whether you're looking at the most recent year's figures or whether would it be appropriate to take an average over a number of years, or perhaps even look at the most recent 3 months performance or the last 6 months performance and then work out what the run rate profitability is based on that. Because when it comes to valuations, it's the future profitability which is most relevant. So if you've got a company that's on a growth trajectory where profits are increasing year on year, then it perhaps be more important to look at the most recent 3 months figures or 6 months figures as a basis for the valuation rather than an average over the last 3 years, say. The other side of that basic profit times multiple equation is the multiple, of course, and this reflects the overall quality of the earnings of the business, its risk, its growth potential, and the risk factors that exist in the business, and it's the blend of all those different risks and growth potential that determine what the earnings multiple needs to be. So there's lots of different things to think about. If it's a business that enjoys a high proportion of recurring revenues, that will lend you to higher earnings multiple. If it's a business with significant barriers to entry and a strong market position, again, that would lead you towards a higher multiple. The spread of customers is an important factor. If it's a business where there's a significant degree of reliance on a very small number of customers, that would be a significant risk in the mind of buyers and would detract from the valuation and lead to a smaller multiple. Growth potential, as I've mentioned, it's the future sort of profitability of the business that is the most fundamental thing. If it's a business that is growing strongly year on year, and there is tangible evidence that the business will continue to grow and increase its profitability in years to come, that's a very significant factor and would lead towards a higher earnings multiple being applied. And strength of management is also a critical issue when it comes to valuing businesses. And this is one of the factors why smaller businesses tend to have lower earnings multiples compared to larger businesses. With a very small business, it might be reliant on one person or two people in the business for its management, and they may be the same people as the owners. Contrast that with larger businesses where there is a much broader management team, less reliance on any particular individuals, and that has a very strong influence on what the earnings multiple will be for a particular business. So there's lots of different things that go into the mix when it comes to determining what the earnings multiple should be. In practical terms, what we find is that for most SME sector privately owned businesses, the overall sort of blend of those sort of risk factors means that it's rare that you see an earnings multiple of perhaps more than 5 with transactions. Again, going back to that point about management, really, I think once you when a business breaks through a particular point and becomes a much more sort of established, larger business with a broader management team, the risk factors are much lower, and the earnings multiple breaks above that sort of figure of 5, which tends to be the sort of ceiling for most transactions we act upon. The earnings multiple is completely subjective. It comes down to judgments as to the overall sort of quality of a business. So there's really no such thing as a lookup table, or there's no reliable lookup table that advisors like us use to sort of determine what the earnings multiple should be for a business. And that's really for the reasons I talked about at the beginning, because there's it's so difficult finding comparable data. Even if you do try and work out what earnings multiples should be for different sectors using published data, that data is so unreliable. It's not really practical to sort of draw conclusions from that. So the earnings multiple is a subjective measure rather than a sort of an objective figure that needs to be looked up. So you take your underlying profit figure, you multiply it by a number, and that gives you your enterprise value or debt and cash free value. That doesn't take into account the debt structure on the balance sheet and any surplus assets. So in order to work out what the equity value is for the shareholders, we need to look at what surplus assets are on the balance sheet. And in most of our clients' businesses, there will be a significant amount of cash held on the balance sheet in excess of the business's day-to-day working capital needs. And that's really a function of tax policy, in that it's punitive for shareholders to take dividends and pay high rates of income tax, and so it's natural that cash reserves do build up on company balance sheets. It's also very common to find freehold property on the balance sheet of trading companies. And as I mentioned earlier, that freehold property usually isn't needed for the business. Yes, the business might use that property to trade from, but it could equally rent that building from a third party. So when working out the valuation, we would assume that the business was renting that building, charge a notional rent for use of that building, and then add on the market value of the property to the debt and cash free value. And the same with any surplus cash, that would also get added on to the valuation. Any debt owed to the bank would come off the valuation. Again, sometimes there's a bit of a grey area as to exactly which debts should be taken off the valuation and which shouldn't. In most cases, it's fairly straightforward. If it's a bank loan repaid over a number of years, that money would need to come off the valuation. In some circumstances, the debt might be more akin to a working capital balance. If it's a revolving credit facility to purchase stock, there could be an argument that that shouldn't affect the valuation. And corporation tax is normally treated as if it were a debt when it comes to working out company valuations, and the amount of corporation tax outstanding at the point a valuation is made, that would also be deducted from the equity value of the shares. It's important to note that it's only the surplus assets of a company that would be added onto the valuation, rather than the entire sort of net assets of a business. And that's because any of the assets that are needed by the business to generate the profits upon which the valuation is based, so the company's working capital, is plant and machinery, it would be double counting to kind of work out a profits-based valuation, and then add on top the value of the actual physical assets and monetary assets that are needed to generate those profits. So what I've talked about so far is the methodology that we use to work out a sort of a standalone value for a business, the value between a willing buyer and a willing seller. A term that you may come across is the strategic premium, where a strategic purchaser would be willing to pay over and above standalone value in order to buy a particular business that would give it some extra benefits. So this sort of situation might come about if you have a corporate purchaser that is pursuing a buy and build strategy and looking to make cost savings by combining lots of businesses together, and benefiting from other sort of synergies, such as cross-selling opportunities. So in that sort of situation, a strategic purchaser may be willing to pay a bit more than standalone value, because it's central to their strategy to buy up several businesses and put them together. And you tend to find this happens most where you've got a very sort of an attractive business which is being bid for by multiple sort of competing trade buyers. It's risky for business owners to assume that this sort of strategic premium can always be achieved when it comes to selling their business, and that's really because in the vast majority of cases, buyers are quite cost sensitive. They want to buy businesses for as little as they can, and only pay a strategic premium if they absolutely have to. So it is quite risky to kind of like think that your business can be sold for more than standalone value. We find that sometimes there's a bit of a tendency for SME business owners to overvalue their businesses rather than undervalue them, and that's natural, really, for a number of reasons. And probably the most important of those is that for most business owners, it's more than simply a profit stream. It's also a big part of their life. It'll be their livelihood. It might also provide jobs for their family members. So a business is worth, it's more than simply the profits, the net profit figure at the bottom of the P&L multiplied by a number. It's far more than that to most business owners. Also, timing comes into it. There's always the potential to increase your sort of value by delaying a sale until further into the future. So those sorts of factors combine to mean that most business owners only really seriously think about selling their business when there's a specific trigger for that. So it could be they want to retire, or there's a health issue. Normally, if they just want to maximize how much their wealth through owning the business, then it's natural for them to carry on owning, operating the business for a longer period. I've noted on this slide, the inherent optimism of entrepreneurs, and I think most of the clients that we deal with and talk to, they are optimistic individuals, and see the upside more than the downside, and that leads them to be naturally more confident about their business's value. On the other hand, buyers, they're much more risk focused, and they will be looking very, very closely at the what could go wrong when it comes to making an acquisition, what the risk factors are in a business, and those risks, they will see those risk factors in a much different way to which the owners would. The owners of a business, they will obviously know absolutely everything there is to know about their business and their customers and their staff, and have a very clear idea about what the actual level of risk is. For buyers, they don't have the benefit of that in-depth knowledge about a business, and will be much more nervous about the perceived level of risk that they see in a business. And as I talked about on the previous slide, there's sometimes an expectation that business owners can sell for a premium value through selling to a trade buyer that's able to make some cost savings. In most cases, trade buyers, they see the cost savings that they make as something that's for their benefit, rather than something that ought to be built into the valuation and increase the amount that they pay. Just concluding on that quick run through on valuations. First of all, a professional business valuation, we think is really important to help owners understand what's driving and draining value in their businesses, and help them make better decisions going forward. So it's not just something that business owners should think about as they're coming up to retirement, or when they're thinking about selling, but at any point in their business life cycle, thinking about what they can do to help grow the capital value of their business going forward. As I've mentioned, be aware of free valuations. It's likely that they'll be very simplistic and give an inaccurate output, or there's a possibility of there being bias, and again, them being inaccurate from that regard. I've talked about valuations mostly being derived from the underlying profitability of the business. There might be some circumstances where balance sheet value is more important, or forecast value, if there isn't that track record of profitability to look back on. But in most cases, it's the underlying profitability, which is the key thing when it comes to working out the valuation of a business. Fourthly, don't assume that all trade buyers will pay premium. In our experience, it's more the exception where trade buyers will pay above the odds to acquire a business. And lastly, don't get too sort of hung up about valuation and price. It's a very, very important aspect of buying and selling a business, of course, but it's not the only important factor. Other things to think about: how saleable is your business? It could be that a business has a very high value, but it's equally very difficult to sell because of different factors. So it's also important to develop a business so that it's easy to sell when the time comes. If you're looking at valuations from the other perspective, if you're looking to buy, how can the deal be funded? That's often a more important thing to think about than the valuation and the price. It's easy to get too hung up about price and what the multiple is, what you're paying for, whereas it's really how much money can be funded and how much money, how much risk is the buyer taking on, which is perhaps the more important thing rather than valuation. And I will hand back over to Andrew at this point. Thank you.
Thanks, Greg. I'm just going to spend a couple of minutes just explaining how we can help. Can I just remind you, if you've got a question you wish to ask, now's a good time to ask a question using the Q&A facility either at the top of your screen or the bottom of your screen, and we'll move on to questions in a couple of minutes' time. So how we can help at the first stage, I talked about earlier about giving early stage advice. A valuation report is often the first contact we have with a new client, giving our professional opinion of what their company value, what the company will fetch in the open market. The reports tend to be quite comprehensive. They're written, they're about 20 pages long typically, and they cover all the calculations, but with detailed explanations as to why we've calculated the valuation in that way. They've got detailed commentary on how we see the business, how we've arrived at the multiple, how we've adjusted the profitability. So they're quite detailed, but they're easy to follow documents that we find our clients find incredibly useful in helping them understand what value they would get for their business if they put it on the market at the current time. So they're also a very useful tool for clients who may be not thinking about selling for 2 or 3 years' time in understanding how their business will be valued. It allows decisions to be taken and actions to be taken that will enhance the valuation and often enhance the saleability. And we often find by clients acting on some of the comments in our report, they can enhance the profit, they can increase the profitability, but also the same actions can increase the multiple. So that can have quite a significant effect on the valuation. If actions you're taking increase both the profitability and the multiple, it has sort of a double effect. Most of the valuations we do come from accountants' recommendations, acting for clients, acting for their clients, often where they don't want to do the work themselves because they perceive a conflict of interest, or they prefer ourselves to do it because we're involved day in, day out in company sales and company purchases. So we have a really good current and up-to-date understanding of how to value businesses. So that's the first thing we can do. And then, as I talked earlier, we can give other early stage advice on the appropriateness of a trade sale, deal activity in the sector, or the appropriateness of a management buyout, how that will be funded. Really, the aim of these early stage services is to give total clarity to a client as to what they are likely to achieve from different routes to allow them to take the right decision on their exit route and the right decision on timing. As I said earlier, we then, our main service is lead deal advisory, take a client all the way through a transaction, whether that's a trade sale, a management buyout, or corporate acquisition. Just before we move on to questions, which we'll do in a few seconds' time, there's a slide there showing the future webinars that are coming up over the next few weeks. Catherine will send out a copy of these slides to everybody who attended today over the next couple of days. So that slide, along with our website, shows that the webinars that are taking place, and you'll be very welcome to join us on any of those webinars. So at this stage, we're going to take questions, and Catherine's going to come back in and talk through the questions we've had. And I know we had some questions before we started by email, and Greg's going to come in and hopefully help answer some of the questions. So over to you, Catherine.
Thanks, Andrew. Hi, everybody. The first question, I think, is a point on terminology that we've used earlier in the presentation. And the question is, what is enterprise value?
Thanks, Catherine. I saw that question when it was asked. I think it was asked just before Greg went on to explain the term enterprise value.
Yeah.
And hopefully we've covered that. But if the person who asked the question wants further details, please get in touch. But to recap, the enterprise value is the same as the cash-free, debt-free value. It's the value you arrive at by taking the underlying profitability, the adjusted profitability that reflects the future profitability multiplied by the multiple. And it's before making any adjustments such as knocking off bank debt or adding on surplus cash or adjusting for other adjustments that are needed.
Okay, thanks, Andrew. The next question is talking about working capital debt. And we mentioned that working capital debt may not always be deducted to determine the equity value. Can you explain what would determine the circumstances where it would or would not be deducted?
I think
I think in most cases it's fairly straightforward, and any bank debt would be deducted from the valuation. I think there are some sort of circumstances where bank debt is sort of more similar to a sort of a trade credit than a bank loan, and in those sorts of situations it might be appropriate to treat it as if it was trade credit. So the kind of, for example, if you've got a sort of a car dealership where there's a finance company providing credit in order for the a dealership to hold a stock of vehicles, then technically that's bank debt and should come off the valuation. But because it is a revolving facility that's needed to is really there in lieu of the sort of the manufacturer of those vehicles providing trade credit, then it's really more appropriate to treat it as as if it's a trade creditor's working capital balance.
I think the starting point is to assume that all funding debt will come off the valuation, but we've seen plenty of different circumstances over the years where we've been able to argue that certain funding debt, as Greg's talked about, should not come off the valuation. But it kind of comes down to professional judgment, and the advisors on the other side may well take a different view. But we've got a fairly successful track record of winning those arguments by getting into the detail when we do the valuations, understanding our client's business, and being able to make a strong case as to why funding debt in certain circumstances should not come off the valuation. I mean, just to give another example, hire purchase liabilities usually come off the valuation. And if somebody's bought a really significant piece of plant and equipment a month before a company sells and has taken HP on to cover that, and that plant and equipment is expected to increase the profitability significantly, either we need to adjust the profitability side of the equation to reflect the future profitability, which isn't certain at this stage, and purchasers probably would be a bit uncomfortable with increasing the profitability when it's not known what it's likely to be. The opposite, the alternative, is just not to knock off the HP that's been taken on the funding debt, because we're not reflecting the increased profitability in the valuation part of the equation. So these things are subjective, they require professional judgment, and the important point is really us getting an understanding of your business in sufficient detail to be able to argue the appropriate case.
Okay, thanks, Andrew. The next question is, how is surplus cash normally calculated?
That's a good question. Do you want to take that, Greg, or shall I? We might give slightly
Yeah,
different.
yeah, I'll give it a stab. But yeah, it is a good question, and this is something that comes up very, very often when it comes to sort of negotiating the detail of transactions, because it's not as straightforward as just sort of taking the cash figure in the accounts, because not all of that is surplus to the business. And, some of it will be needed for day-to-day sort of banking transactions and paying wages and paying suppliers. So it's necessary usually to do quite a lot of sort of detailed calculations to work out what the surplus cash is, and normally that it involves looking at the balance sheet of a company over, say, the last 12 months, working out what the average working capital requirements is during that period, identifying any sort of peaks in terms, if it's a business where VAT is a significant amount and gets paid quarterly, then that needs to be taken into account. So it's not straightforward. Again, this is one of those areas that does require professional judgment, and is often a negotiation point in transactions, and can make quite a significant difference to the overall equity value of the business. But yeah, basically it involves working out a normalized level of working capital, comparing that to the level of working capital that exists at the point the transaction takes place, and that will give either a sort of an upward or a downward adjustment to the price, and then whatever the cash figure is at the completion of a transaction, that would be added on to the valuation. So you'll have a sort of a positive adjustment for cash, and then a sort of a downward adjustment for working capital, and the sort of the net of those two figures, I guess, is the surplus cash effectively.
It is an important point on transactions, and we do, as Greg says, get into the detail so we can argue the case for our clients. It's not a figure that changes day by day. The method that Greg has explained means that your cash and your bank balances will go up and down throughout the month, and you'll pay your salaries at the end of the month, and you pay your VAT on a certain date. Those individual transactions should not affect the amount of surplus cash. The method we're using ensures the figure remains the same, irrespective of what day in the month you complete the transaction. But it is an important point because, as Greg said earlier, clients have been retaining cash on the balance sheet because of the pain of taking out significant dividends in terms of the amount of income tax that needs to be paid. So most of our clients, the surplus cash extraction is a significant extra consideration as part of the deal.
Okay, thanks Andrew and Greg on that one. Right, the last question at the moment is what impact is the COVID pandemic having on valuations, and how is that being reflected?
Shall I give that a go, Greg?
Go on.
I mean, it's something we're considering on all the evaluations we're doing at the moment, and we've probably seen more clients who seem to have benefited from COVID than have suffered. But what we're looking at in evaluation is the future profitability. So what's the future going to look like? And for certain clients, based on how they performed over the last 18 months or so, it is possible to be, there's some degree of certainty as to what the future looks like. And we can therefore do evaluation based on what we think the future profitability is likely to be. For other clients, there's still, clients maybe providing services in the hospitality sector or in the hospitality sector. The future profitability is still uncertain, and therefore businesses that are still suffering and suffering badly, it's probably not a good time to do evaluation, because evaluation needs to reflect future profitability, and where there's a big degree of uncertainty on future profitability, evaluation could be inaccurate. But we're doing plenty of evaluations of clients that have performed well over the last 18 months. And as I say, some have gained from COVID, and therefore the current, the profitability achieved over the last couple of 18 months or so is likely to fall again at some stage in the future. So it's using a judgment, but importantly, we give our comments in the valuation as to what we've done, why we've done it. And yeah, the future might turn out differently, but there's sufficient information in our valuation reports for our clients to then adjust the valuations if things do turn out differently. Do you want to add anything to that, Greg?
Yeah, I think I'll just say that as far as we've seen, there's not been any sort of impacts in terms of lowering valuations. Certainly, I think that there's a huge amount of appetite out there from people and companies wanting to buy businesses and expand. And the funding environment is very sort of positive at the moment. So there's plenty of money available for people to go and make acquisitions. So yeah, I think things look very favourable at the moment for valuations and transactions in general.
Okay, thanks. That's all the questions for now.
Okay, thanks, Catherine. So if you do have any other questions, please do. Catherine will send you the slides over the next couple of days. We'll welcome the opportunity to talk to you individually. We've talked in general terms today, but we welcome the opportunity to talk to you individually. So if you'd like a Zoom call to talk about your business, or if you're an accountant to talk about how we can work together, we'd welcome that opportunity. Catherine will send you an email with the slides and offer the opportunity to have a chat. If you've got any questions, just respond to that email, or if you'd like a chat specifically about your business, we'd love to talk to you. So thank you for listening. I'm going to finish the webinar at this point, and as I say, we've got other webinars coming up soon. Please do join us if you feel those topics are relevant to yourselves, and hopefully we'll get to speak to many of you over the next few weeks. Thank you for listening.